Hello everyone, my name is Irene and I'm here with two of my friends.
My name is Fahri.
My name is Netado.
And today we're gonna talk about the application of financial analysis in real estate industry, especially in PT Summarecon Agung and PT Ciputra Development. This project is part of Business Analysis and Valuation subject in Faculty of Economic and Business University of Indonesia. Next slide, please. This is the contents that we're going to present today, which consists of theory, company profile, application in SMRA and CTRA, and last is conclusion and recommendation. Next slide, please. We'll start with the company overview. The first company that we're going to analyze is PT Ciputra Development or CTRA. This company is established in 1981 and part of Ciputra Business Group. PT Ciputra Development is one of the leading and most diversified property companies in Indonesia, with market capitalization of 17 million. The company has developed more than 76 projects in 33 cities around Indonesia. Some of their products, such as residential and apartment, a shopping center, hotel, hospital, and others. Next slide, please. And the next company is PT Summarecon Agung, or also known as SMRA, which established in 1975. Summarecon is one of the most prominent property developers in Indonesia, especially in developed townships. The company has achieved and some awards such as Golden Property Awards 2021, Best Regional Scale Development, Golden Property Award in Best Premium Housing Development, and Cluster Horizon Summarecon Bekasi. Next slide, please. First of all, we're going to talk about the financial analysis theory. Next slide. The first is the drivers of a firm profitability and growth, which consists of operating product market strategies and financial market strategies. And for further explanation, we will explain in the next slide. Next slide, please. In general, there are a lot of tools that can be used to measure profitability of a firm, such as ROE and ROA. And based on traditional approach, a company's ROE is affected by how big the firm asset relative to shareholders investment, and it can be decomposed into return on asset and financial leverage, and also the equity multiplier. But there is also some limitation in the computation of ROA, such as there is a different tools in valuing operating asset and a non-operating investment, and therefore mixing operating with non-operating assets would affect investment value. And the computation of ROE using alternative approach is as follows. Next slide, please. In product market strategies, there are operating management and investment management. First is operating management, that managing revenue and expense usually using ROA tools. And first, there is gross profit margin, which influenced by the price premium that a firm's products or services command in the marketplace and the efficiency of the firm's procurement and production process. Second, there is NOPAT and EBITDA margin, which provides a comprehensive indication of the operating performance of a company. It is used to measure the efficiency of a firm in using their non-current asset to generate revenue. Next slide, please. Next is investment management in order to manage working capital and fixed asset of a company. Since majority of organizations spend significant resources in their assets, asset turnover is an important thing to analyze a firm's ROE. Asset turnover also enables analysts to assess the success of company's investment management. And for working capital management, there are lots of tools as percentage, such as operating working capital ratio, receivable turnover, inventory turnover, and others. And There are also decomposing asset turnover. That is an alternative measure that distinguishes between operating working capital components in working capital. And for non-current operating assets, there are net non-current operating assets turnover and PPA turnover. Next slide, please. In financial market policies, there are financing decision and dividend policy. Financing decision is activity to manage liabilities and equity, both long-term and short-term. And as you can see, there are lots of tools to measure the liquidity and solvency of a firm. Analysts often examine ratios using disaggregated financial and physical data from management commentary or financial statement, segment disclosures, which is very useful for emerging companies and industry where conservative accounting regulation may distort business economics. Next slide, please. Lastly, there are sustainable growth rates, which consists of dividend payout ratio. Dividend payout ratio to examine company ratio holistically. A sustainable growth rate can be defined as a rate at which a company may expand while maintaining its profitability and financial practice. ROE and dividend payout ratio will determine how much funds available for a firm to grow. Next slide, please. And also, company also need to analyze their cash flow in order to give further insights about companies' operating, investing, and financing activities. That is because positive operating cash flow after making operating working capital investment will allow the firm to pursue long-term growth opportunities. And hereby attached is the example format of standardized cash flow of a company. Positive operating cash flow of firms will make firms categorized as a healthy if they generate more cash from customer rather than operating expense. And growing firms sometimes may experience a negative operating cash flow because they need to do a research and development, marketing activities, and also company development. Next slide, please.
Okay, so after some theory explanation, next we are going to explain regarding financial analysis application for both company. So first, I'm going to explain regarding the over profitability. If we see both the number of ROA and also ROE from SMRA and also CTRA, we can see that basically both company has a stable asset turnover, which both at 0.2. Despite this ratio actually can be considered as low, however, considering the fact that both companies are within the same industry, which is the real estate industry, therefore we can see that this number, 0.2, can be categorized as a good turnover ratio. For further explanation, in 2021, we can see that specifically CTRA experienced a decrease in the ROE ratio, in which further analysis show that the reason why there was a decrease for ROE is because there is a decrease in the net profit margin. Further analysis shows that CTRA expense is increasing. On the other hand, it can be seen that CTRA shows a really good performance because there's an increase of ROE by about 5.6% as a result of their efficiency in managing its expenses. Moreover, from this ROE alternative approach, we can see that from our analysis that SMRA basically has a lower ROE in comparison to CTRA due to the fact that SMRA has higher net investment profit after tax, or can be also mentioned as NIPAT, as well as their net operating profit after taxes, and can be also mentioned as NOPAT. Furthermore, SMRA's low ROE is also attributable to the lower business asset that the company has in comparison to the CTRA. Next, I'm going to explain regarding the operating management for both companies. We can see in 2020, the NOPAT and also the EBITDA margins for both companies, SMRA and CTRA, are declining. However, if we see even further, we can see that the value that CTRA own actually better in comparison to SMRA. This means that CTRA has better capability in controlling its operational expenditure during the COVID-19 pandemic. Also, from this operating management analysis, we can also see that CTRA has a higher profit margin in comparison to SMRA in the year of 2021. We believe the reason why there is why CTRA has higher profit margin is due to the fact that CTRA has the profit margin of CTRA have increased due to the lowering in cost of revenue and operational expenses. In addition to that, CTRA has also the capability to lowering its depreciation and amortization for 2021. From this operating management analysis, we can see that SMRA also suffered from a reduce in the gross profit margin for 2021 as other operating incomes or expenses increase. Next, I'm going to explain regarding the investment management. First, I'm going to explain regarding the ratio analysis for 2021. The first thing first, we need to see regarding the operating working capital to sales ratio. In which we can see that for 2021, SMRA has better capability in generating revenue by using its working capital in comparison than CTRA, because we can see that the number is definitely higher, almost twice as in comparison to the next one. Several ratios were covered. There are operating turnover, trade receivable turnover, inventory turnover, and last but not least will be the trade payable turnover. So based on our analysis from these turnover ratios, we can see that basically SMRA has better efficiency in comparison to CTRA. For example, the trade receivable turnover ratio. We can see that SMRA has higher trade receivable turnover ratio in comparison to CTRA, which means that SMRA can collect more trade receivable in comparison to CTRA. Another example that we can see why SMRA performs better in at the trade payables ratio, trade turnover ratio, in which we can see that SMRA has significantly higher number than CTRA, which means that SMRA has better capability to pay its trade payables in comparison to CTRA. The next ratio, still within the investment management framework ratios, will be the days receivable, days inventories, and also days payable. From the analysis, we can see that overall, SMRA has better capability in collecting its receivable, its inventories, and also has better capability to pay its payable with less days in comparison to CTRA. Last but not least will be for the non-current asset investment management ratio. There are two of this ratio that we need to see. The first one will be the net non-current operating asset turnover, and the next will be the PPE turnover. In contrast to the previous ratio that I've previously mentioned before, we can see that overall, CTRA has better capability to utilize its non-current asset for revenue generation. So that will be the ratio analysis for 2021. And next, we are going to focusing on the time series analysis. So from time series analysis, we can see that both company actually has lower performance in 2021 than in 2020. We believe that the reason why this happened is because both company previously faced the consequences of the COVID-19 pandemic. We believe that both companies need to adjust on how it uses its working capital and also non-current asset as a result of the sudden existence of the pandemic in the year of 2020. Next, I'm going to explain regarding the financial leverage for both companies. Based on our analysis, we can see that basically CTRA outperformed SMRA in the liquidity ratio, specifically in current, quick, cash, as well as the opening cash flow ratios. We believe since CTRA's current asset exceed their current liabilities, the current obligation for CTRA might be less vulnerable than SMRA. Further analysis for financial leverage shows that CTRA outperformed SMRA in liabilities to equity, debt to equity, and debt to capital solvability ratio. This means that CTRA liabilities and equity basically more balanced in comparison to what SMRA has. If we compare the liquidity ratio of both companies, we can see that the liquidity ratio basically increased for 2021. We believe this might happen due to the improved economic conditions in comparison to the previous year, the year of 2020, when pandemic COVID-19 hit the world for the very first time. Next will be the sustainable growth rate. First, I'm going to explain the analysis per the year of 2021. We can see that from this analysis, we can see that both businesses actually have favorable sustainable growth rates, or SGR. However, it can be shown per year of 2021, actually CTRA can outperform SMRA in terms of the rate itself. According to this result, CTRA is basically better in comparison to SMRA. Additionally, because CTRA has higher rate, we believe that CTRA will develop faster in comparison to SMRA without having additional funding from the lenders through debt, and also from the investor through the equity. So that will be analysis for the year of 2021. And for the time series analysis, we can see that actually both business have an increase in the sustainable growth rate. We believe that the reason why both businesses have capability to increase its SGR is because due to the fact that both company have raised its outside funding. Next, we're going to focusing on the cash flow analysis. Both companies faced the COVID-19 pandemic, right? However, based on our analysis, we can see that the COVID-19 pandemic actually impacted SMRA cash flow even worse in comparison to CTRA. For financial analysis, for cash flow analysis per the year of 2020, we can see that SMRA experienced a significant loss, reaching a net decrease in a cash balance for up to 7.942 million. However, in contrast to CTRA, we can see that during the pandemic, actually CTRA has better capability to maintain its cash flow, because we can see that the cash flow of CTRA per year of 2020 has actually increased in comparison to SMRA. Going dive deep in 2021, due to the fact that economic condition is actually improving and the real estate is getting better, we can see that both SMRA and also CTRA has better ability to generate cash flow from its operation in the most significant manner. We believe this could happen because both company can increase its cash receipt from the customer. In the year of 2020, we can see from our analysis that SMRA experienced a significant decrease in their free cash flow available to equity. This analysis shows that the company SMRA during the year of 2020 relied heavily on their financing because there is an increase in the net debt issuance. So after looking at the stockholder annual general meeting that was held on 12 August 2020 and also on 24 August 2021, SMRA stockholders previously approved that there will be no cash dividend that was distributed. So that will be for the year 2020. And in the year of 2021, we can see that both SMRA and also CTRA use their cash to repay their debt, that decrease the free cash flow available to equity value. The net investment in non-current asset is increasing in 2020 and in 2021 because there is an increase on the investment in associates.
So for the last, I will talk about conclusion and recommendation. Next, please. So to sum up our group presentation today, I will give some point. A ratio analysis reveals that the two firms have operated drastically differently over the previous 2 years. CTRA outperforms SMRA in terms of liquidity ratio. However, the debt and coverage ratio indicate that SMRA may outperform CTRA. Using time series analysis, the judgments on both firms' performance may be summed up by their sustainable growth rate, indicating that CTRA can outperform SMRA in general. Asset management ratio, in addition to the ratio described above, may be used to assess how well both organizations are doing. Ratio demonstrate the one group has a distinct edge over the other. As a response to the company financial statement analysis, our group give various recommendations that are very necessary for real estate company as well as SMRA and CTRA companies. The real, the real estate property business will continue to develop over time as will need for housing. As a result, business must be able to innovate in terms of their products through differentiations. Strategies such as more innovative designs, strategic location at affordable costs, dwelling kinds provided, and so on. Company must also consider digitalizations in product creations, such as with digital property, which is electronic information that someone generates or owns. The data is stored in either an online cloud file storage systems or in a physical format. For example, if someone has a money in vault or safe, the vault key or digital code is worth the same as the safe itself. Similarly, the password to cloud account containing valuable objects is effectively a digital property and in of itself. Furthermore, especially for SMRA, they must pay more attention to their cash flow, as there will be a drastic increase in 2020. And they must be able to maintain so that the increase is not only temporary, whereas CTRA must always maintain so that its already good performance remains stable and does not decrease over the time. Next, please. Okay, thank you for your interest in our presentation. Please do not hesitate to ask any questions, and we will see you next Monday morning. Thank you.